Watch video 34 on Chapter 8 Taxation from the Workbook for NISM Series 5A, Mutual Fund Distributors Certification Examination, and review the multiple choice questions and answers. 1. What was the tax treatment of dividend income from mutual funds before the Union Budget of 2020? A. Tax-free in the hands of the investor. B. Taxed at a flat rate of 10%. C. Included in taxable income of the investor. D. Taxed only if income exceeded Rs 1 lakh. Answer: A. Tax-free in the hands of the investor. 2. What significant change regarding dividends was introduced in the Union Budget 2020? A. Dividend income is now tax-free for all investors. B. Dividend distribution tax was abolished, and dividends are taxed in the hands of investors. C. Dividend income is taxed only if the investor is in the highest tax slab. D. Dividends are now taxed at a flat rate of 15%. Answer: B. Dividend distribution tax was abolished, and dividends are taxed in the hands of investors. 3. In the new regime, tax on dividends is based on A. A flat rate. B. The applicable tax rate based on total income. C. A specific mutual fund tax rate. D. The previous year's income. Answer: B. The applicable tax rate based on total income. 4. Under the new regime, who benefits the most from the changes in dividend taxation? A. High-income individuals. B. Charitable trusts and individuals in tax-exempt categories. C. Non-resident Indians. D. All investors. Answer: B. Charitable trusts and individuals in tax-exempt categories. 5. What is a major difference between the old and new tax regimes for dividends? A. Dividend distribution tax could be set off against other tax liabilities. B. Tax on dividends can be reduced through exemptions in the new regime. C. Dividend income was entirely exempt in both regimes. D. NAV drop does not affect the tax calculation. Answer: B. Tax on dividends can be reduced through exemptions in the new regime. 6. In the earlier regime, the NAV dropped by A. Dividend paid plus dividend distribution tax. B. Dividend paid only. C. Tax on dividends. D. Total income tax payable by the investor. Answer: A. Dividend paid plus dividend distribution tax. 7. What is deferment of taxes in the context of mutual funds? A. Delaying tax payment by choosing a growth option. B. Paying taxes upfront. C. Paying taxes when dividends are declared. D. None of the above. Answer: A. Delaying tax payment by choosing a growth option. 8. From April 1, 2021, mutual funds declaring dividends must indicate A. The amount of capital distribution. B. How much is due to appreciation of NAV and how much is capital distribution. C. The tax slab of the investor. D. The dividend distribution tax applicable. Answer: B. How much is due to appreciation of NAV and how much is capital distribution. 9. Stamp duty on mutual fund units is applicable for A. Lump sum investments. B. Systematic investment plan, SIP. C. Reinvestment of dividend. D. All of the above. Answer: D. All of the above. 10. The rate of stamp duty on mutual fund unit purchases is A. 0.01%. B. 0.005%. C. 0.015%. D. 1%. Answer: B. 0.005%. 11. Which of the following is not subject to stamp duty? A. Purchase of mutual fund units. B. Transfer of mutual fund units between demat accounts. C. Redemption of mutual fund units. D. Reinvestment of income distribution. Answer: C. Redemption of mutual fund units. 12. What is bonus stripping in mutual funds? A. selling bonus units at a loss for tax benefits. B. A method of reinvesting dividends. C. A process where NAV is stripped of value. D. The distribution of extra units as a bonus. Answer: A. Selling bonus units at a loss for tax benefits. 13. What is the condition under which capital loss from bonus stripping cannot be set off? A. If the units are sold within 9 months after the bonus issue. B. If the units are bought 6 months prior to the bonus issue. C. If the units are held for 12 months. D. None of the above. Answer: A. If the units are sold within 9 months after the bonus issue. 14. What is the securities transaction tax, STT, applicable on the sale of equity mutual funds, delivery based? A. 0.025%. B. 0.001%. C. 0.015%. D. 0.005%. Answer: B. 0.001%. 15. STT is not applicable to A. Purchase of equity mutual fund units. B. Sale of equity mutual fund units. C. Redemption of debt mutual fund units. D. Both A and C. Answer: D. Both A and C. 16. Which mutual fund schemes offer tax benefits under Section 80C? A. Equity-linked savings schemes, ELSS. B. Debt funds. C. Balanced funds. D. Exchange-traded funds, ETFs. Answer: A. Equity-linked savings schemes, ELSS. 17. The lock-in period for ELSS under Section 80C is A. 1 year. B. 3 years. C. 5 years. D. No lock-in. Answer: B. 3 years. 18. In case of ELSS investments made via SIP, the lock-in period applies to A. The entire SIP amount. B. Each installment individually. C. The total value of all installments. D. The first installment only. Answer: B. Each installment individually. 19. Under the new tax regime introduced in Union Budget 2020, what happens to tax exemptions under Section 80C? A. They remain the same. B. They are no longer available. C. They are increased. D. They are applicable only to senior citizens. Answer: B. They are no longer available. 20. Which of the following attracts TDS under mutual fund dividend income? A. Dividend income below 5,000 rupees. B. Dividend income exceeding 5,000 rupees. C. Growth option mutual funds. D. All mutual fund income. Answer: B. Dividend income exceeding 5,000 rupees. 21. The rate of TDS on mutual fund dividends exceeding 5,000 rupees for residents is A. 5%. B. 10%. C. 20%. D. 30%. Answer: B. 10%. 22. For non-resident investors, TDS on dividends is based on A. A flat 20% rate. B. The lower of income tax regulations or the DTAA rate. C. The investor's home country tax rate. D. None of the above. Answer: B. The lower of income tax regulations or the DTAA rate. 23. Which tax is applied on investment management and advisory fees for mutual funds? A. Income tax. B. Stamp duty. C. GST. D. STT. Answer: C. GST. 24. GST on brokerage and transaction costs for mutual funds is within A. The total expense ratio, TER, limits. B. The stamp duty limits. C. The STT rates. D. Not applicable. Answer: A. The total expense ratio, TER, limits. 25. Can GST be charged to the scheme for distributor commissions in mutual funds? A. Yes. B. No. C. Only in equity funds. D. Only in debt funds. Answer, B, number 26. What happens to the GST on exit load? A. It is deducted from the exit load amount. B. It is added to the scheme expenses. C. It is charged to the investor directly. D. It is waived off. Answer, A. It is deducted from the exit load amount. 27. TDS is not applicable on A. Repurchase proceeds for resident investors. B. Dividend payouts for resident investors. C. Capital gains from mutual funds. D. All repurchase proceeds. Answer, A. Repurchase proceeds for resident investors. 28. Which of the following statements is true regarding double taxation treaties, DTAA? A. They ensure that non-residents are taxed twice on dividend income. B. They provide a lower tax rate for non-residents under certain conditions. C. They apply only to capital gains, not dividend income. D. They are not applicable to mutual fund investments. Answer, B. They provide a lower tax rate for non-residents under certain conditions. 29. The lock-in period for tax benefits under retirement-oriented funds is A. 1 year. B. 3 years. C. 5 years. D. No lock-in. Answer, C. 5 years. 30. Which tax benefit is allowed for retirement-oriented funds? A. Section 80C. B. Section 10. C. Section 24. D. Section 50. Answer, A. Section 80C.